Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Tuesday. I'm Andrew Gagan. Good to have your company as we unpack the day, which made an impressive comeback on the local index. In fact, just checking in the COB 200 there, as you can see, up 0.6% on the S&P AS 200. 0.5%, all that heavy lifting done in the afternoon session, having begun negatively despite oil prices continuing to fall, but we did see a big drag on tech stocks in the US, the ongoing concerns about those circular deals being done in the midst of earnings season, and that's also played out in Asia as well. So just locally, consumer discretionary, that did well. Energy actually making a bit of a comeback. But South Korean shares, they plunged on that global sell-off in chip makers, pressured by concerns over intensifying competition from China. The Kospi down more than 7%. Those memory chip giants, Samsung, SK Hynix, down around 13% or more. So to those themes of the day there, crude catalysts. So that was obviously more broadly what we're seeing in the market at the moment, with lower crude prices, perhaps dissipation of hostilities in the Middle East. Droneshield, I'll get to that in just a moment. That is Droneshield, down again, in fact, down to the lows of we saw back in December, and semi-sell-off. In fact, I was just reading a headline from Reuters, where it's talking about those fried, battered and burnt chips, those chip stocks. All right, let's get to the sectors of the day then. Consumer discretionary, actually the leading one today. Interesting, because these are going to be in focus tomorrow when we get the CPI rate, the quarterly read on inflation ahead of the next RBA meeting. Of course, that's been one of the most sensitive sectors. So making a good comeback today, led by JB Hi-Fi. Lavisa, up 7.5%. Checking in on the telcos, that was another impressive sector today, led by gains in Superloop. And the miners, mostly in the negative there, dragged lower by Rio Tinto, BHP coming off as well. Mineral resources, in fact, a lot of pain been felt among the lithium miners, also in uranium as well. So let's get to the stories of the day then. A number of quarterly updates. Whitehaven Coal falling despite finishing FY26 at the top end of production guidance, with a managed run of mine coal production reaching more than 40 million tonnes. Web Travel, that surged after announcing plans for a share buyback of up to $90 million and forecasting first half underlying earnings of up to 86 million. Droneshield, as I was mentioning, so down 12%. That's its lowest level since December, after warning of margin pressure, with first half gross margins expected to fall to 60% from a year earlier. Harvey Norman, it actually bucked the trend there. That is despite the federal court fining the retailer $35 million over a misleading advertising campaign run with Latitude Financial, following action from the corporate regulator. Viva Energy expecting first half EBITDA to surge by up to 780 million from 305 million a year earlier, driven by a sharp lift in regional refining margins. IGO, that's divesting its Nova operations to Global Lithium after mining concludes in the December quarter. And Ryman Healthcare reporting positive free cash flow of 188 million for the year to June. Best result in more than a decade, in fact. First positive result, I should say, in more than a decade. Now, Reserve Bank Governor Michelle Bullock has said the full effect of the RBA's 3 rate rises this year had yet to flow through to the economy, and the outlook remained uncertain given rapidly changing conditions in the Middle East. However, she warned that underlying inflation remained too high, and a further slowdown in domestic demand may be required to tame prices. In other words, beware, more rate hikes could be upon us. Let's talk central banks and more on what we're doing in the markets at the moment. And George Barbour is joining us from K2 Asset Management. George, welcome back to you. Lots of central bank action at the moment, obviously with the focus this week on the Fed. We've got the Bank of England, the Bank of Japan at the end of the week, ahead of our own RBA. Can I just start with those comments from Michelle Bullock? So obviously, a bit of a warning shot there saying, look, we may well have to tighten further given those underlying inflationary pressures.
Good afternoon. Yes, Michelle Bullock is 100% correct. It needs to remain with that hawkish language as much as possible, given that we've got such high headline and core inflation, in particular compared to our peers offshore. So everyone's got an inflation problem around the world. It's just that Australia's more amplified, which is a little bit disturbing, hence their reaction and hence her language going forward. And it is also true that the 3 rate rises most recently haven't worked their way through. It has worked its way through, I would say, on the sentiment side, because it's so low, and obviously housing clearance rates. But in the main, we do have a core inflation problem that's persistent and higher again versus our peers. Hawkish language, 1 more rate rise before year end. And the disclaimer I would say that is that when you hear headlines that house prices in Melbourne and Sydney are sluggish, that is doing some of the RBA's work for it. So that's why we say 1 more rate hike seems to be about right with more hawkish language, given where sentiment is so weak and low, particularly in Melbourne.
Yeah, in fact, she made reference of that to Michelle Bullock, saying the central bank surprised perhaps of the extent of the falls we're seeing in the property market. She did reference, obviously, those policy changes courtesy of the budget. So clearly that is, as you say, doing some of that to work for the RBA. George, as I mentioned, they're also obviously the Fed in focus. It does mean Wednesday US time. What are the expectations there? So less than 40% chance of a rate hike, but the markets are pricing in almost 100% chance by September, I think. I mean, what are the issues that they're facing there in the States in terms of inflation?
Yeah, so it's many moving parts. Very quickly, for about a third of people to be pricing in a rate hike in this current meeting, up from about, say, 16% last week. That's just hedging, just people with a binary outcome hedging their book. So I'll dismiss it, and it's extraordinarily highly improbable anything will happen this week. At the next FOMC meeting, that's when they've got that 100% chance, but the predication of that, or the estimation and the forward guidance of that, remember the Fed's moving away from forward guidance and trying to look at concrete data, because forward guidance has been so wrong as per the dot plots over the past 5 or 6 years. So while the market is pricing it in, they're really pricing it in as an extension of higher energy prices and working its way through into secondary market effects and the tariffs, even though that hasn't had a sustained second round effect that's been entrenched. Nevertheless, the market's pricing that in. But most important for your viewers, if I may reinforce and directly push this point, is that this is a new look Fed with a more minimalist, less guidance outlook that is determined to lower and decrease the size of the Fed's balance sheet, thereby sometime in the future with a smaller balance sheet, when they raise or increase or lower Fed funds rate going forward, it have a more direct impact to the economy as opposed to where it's been over the past 6 or 7 years, where it's been negated to some effect given the size of the balance sheet. And this is very important. So less guidance, less communication, looking at the data. People will be second guessing, but again, reinforcing that the new incoming chair has reinforced that the Fed has got the guidance so wrong for so long, but it wants to reinforce that, lower the balance sheet, so when you do change policy, it has that direct impact into the market.
So George, that's one key focus for investors this week. The other, of course, being more earnings results, particularly from those hyperscalers, among them Amazon, Meta, Microsoft, Apple also. Interestingly, what we saw overnight in that session gone, that Apple actually overtook Nvidia as the largest company. Nvidia fell back about 5%. Look, those chip stocks are under significant pressure, and I guess there's real concern there about the circular deals being done at the moment.
Circular deals, look, the earnings have been explosive and historical and extraordinarily large. And that is why the multiple hasn't really fallen away, because the denominator of the EPS has been coming through and been very strong. It's just that in the past quarterly earnings and the current one, it's a bit of a catch-22. And we saw it with Google. Google increased last week its capex spend from 190 billion expectation to that 205 billion. And even though they're fast tracking to build out the capacity to grow the earnings even further, that now is a negative. At the other side of it, if you cut back your capex, that would also be seen as a negative. So therefore, you get a sense that the market is that fully valued, particularly in the AI and the chip stocks. While it's very difficult about market timing, the thing to reinforce here is that the earnings are coming through. It's just that we are discounting the moat, the expectation that these companies can keep growing these earnings into the next 3, 5, and 7 years. And because the moat's not there, therefore the multiple's not expanding, and people are just being a bit more conservative in that outlook. Therefore, we are looking at the second round effects, impact on financials. We like US financials. Transport, we like that, and utilities in the US and healthcare. We believe will be the second round positive EPS upside of those sectors at the cost of the AI chip maker play.
And George, locally, of course, reporting season beginning next week. What are the expectations there? I see you're pointing to some challenging margin growth ahead. Overall, what are you seeing?
The overall overgeneralisation disclaimer, but the banks in Australia, margin pressure, so their dividend play, don't expect too much capital growth over a 1-year view, but expect that dividend to come through. Bad and doubtful debts, we're not as pessimistic as some. Yes, the lower house prices are a bit of a ways and it's a bit of a headwind, and they are expensive banks versus offshore, but we are not overweight Aussie banks, we're overweight US banks, but Aussie banks are really that dividend play, don't expect capital gains too much, and again, margin pressure, net interest margins. Very quickly, we like the exporters still, which means more volatile. You're taking more volatility on board in your portfolio, but we like exporters because they're detached from the domestic cycle, which we think is quite pessimistic in Australia. So we like the exporters, whether it's materials, metals, energy. Any drawdown or reversal, we say they're the places to go into because of M&A activity. We believe will continue, particularly what's going on in the Gulf at the moment. Particularly LNG players like Santos is the prime target for M&A still into calendar 2027. So domestic focused stocks still got a headwind with margin pressure, high cost, but financials, income play, export sector is where we'd like to be focused on. Not overweight Australia, but remember, being overweight on that neutral in materials means it's taken on more risk because of the volatility of resources and energy in their nature.
George, bonds, where are you seeing the best value at the moment?
Very quickly on fixed income, I always like to say that the Greek 10-year bond yield is lower persistently because of its more disciplined government fiscal spend over the past decade. A lot of people don't believe that, and paying back their debt back to Brussels at a faster rate. But lower bond yields, better fiscal discipline in the Greek long bond yield versus France and the UK, which has got the yields are rising. They've got a lot of pressure, just keeps month by month, year by year. They've got problems for future issuance in the UK and future issuance in France. Where we like debt yields that are rising, the US 10-year towards 470, we believe that's about right because they've got a better outlook on core inflation than their peers, particularly across the G7. So we like buying the US 10-year at these levels. And again, I'm highlighting that the Greek 10-year bond yield still is lower, so it's more expensive than the French and the UK 10-year.
And George, you have a new leader there in Victoria with Jacinda Allen stepping down and Ben Carroll stepping up to the plate. Look, they've got a lot of issues to deal with in your state at the moment, in particular a debt issue.
Yes, so the baton's handed over leading into the November election. So Ben Carroll, Gabriel, the two IC will come through. They'll obviously, I suspect it's well engineered leading into a campaign into the election. So it's effective, the election starts from today, from their perspective. And yes, there is a debt issuance that's to be tackled going forward. And while I can't say much about that, we can all highlight that as a Victorian, we're very happy with the contribution from New South Wales, Queensland and WA on the GST realignment to sort of help subsidise the Victorian economy. But tongue-in-cheek, but the election campaign effectively began today. This is a new leadership structure, and we'll be keen to see how they roll that out and see how the opposition and One Nation deal with the upcoming long campaign in November.
Oh goodness, it does seem long with the Victorian election. Then we're talking federal politics, very volatile at the moment. George, great to get across it all. Thanks for joining us on K2 Asset Management.
Thank you. Cheerio.
Let's turn to our stock of the day. As I mentioned, Droneshield, that was our stock of the day, given it has fallen substantially after warning margins would come under pressure as sales mix, currency movements, and one-off costs weighed on profitability. Let's hear from our experts, Philip Pepe from Shaw and Partners and Rudy Philip Van Dyke from FN Arena.
The inbred resistance against overcrowded trades, and I think Droneshield has on many occasions been the overcrowded trade. There's lots of stuff I don't like about it. Those people specialized in putting valuations on companies, they most often than not believe that Droneshield most of the time is overvalued. I think there are my main gripe still remains with the guys who are leading this company and how they treat investors and all of that.
What surprises me is the margin pressure. Normally at this stage of the economic life cycle, margins should be improving. They flagged the margin decline from 65% to 60% for first cross. The other thing that surprised me was how wrong consensus was. They've guided to, I think, 250 to 270 mil revenue for this year. They've got 200 mil odd in the bag. Consensus was at 350. 350. That's like a 40% miss. So analysts should have been aware of that. Maybe the company could have put out this trading update early because the market was just wrong. So I'm surprised it's only down 10%, where it's a 40%, 40% miss.
All right, let's wrap up the best and worst in today's trade then, beginning with those in the green. WiseTech bouncing back strongly, 9% higher. Light and Wonder also doing well. And in the consumer discretionary space, Lavisa up more than 7%. In fact, we saw that across the sector today. And Viva Energy making a bit of a comeback too. Well, that's actually off the back of an update to the market, but more broadly what we've seen in energy stocks, they're higher despite the oil price plunging overnight. Those ending in the red, Droneshield, top of the list there, did end up down 12%. Also in the uranium space, Silex Systems, Electro-Optic Systems also under pressure in that similar space to Droneshield, and lithium stocks as well being hurt. Whitehaven out with its release this morning. Well, let's take a look at what is out overnight. Well, that's actually US consumer confidence is out, and we have separately an OPEC meeting. That'll be interesting given what's going on, of course, in the Middle East. Industrial production out of India. And in terms of US earnings, Visa, Coke, Boeing, S&P Global reporting. And tomorrow, our time here, the focus very much on that second quarter read on inflation. You do get that CPI data, which will obviously inform the RBA on its next meeting, and quarterly updates from Atlas Arteria, Greatland, Mineral Resources, Northern Star, and earnings reports from Rio and Nickel Industries. So let's take a look at where we've landed. Rallying into the close, at least, well, on the SIBO, up almost 0.6%. On the S&P ASX 200, we are up 0.6%. Strong finish. And in fact, we're currently up almost 2% over the past 5 days. That is the COB. Well, of course, we'll do it all again tomorrow. As I said, the focus very much on that key inflation report. Thanks for watching and listening.